Hi, my name is Carl Pino, host of Janusian Economics. We explore economics and geopolitics in a rapidly changing multipolar world. To learn more, please like this video and subscribe to this channel.
If you are an oil exporter, and Putin gave us a detailed speech about this in June, and of course it was ignored in the Western media because it was Putin and whatever. You are seeing peak cheap energy all over. You're seeing depleting oil wells. You are seeing energy. The cost to replace oil reserves is rising inexorably everywhere. So if you're an oil exporter, you sell oil, you run a surplus, where do you put those surpluses? Do you put them in sovereign debt, which we just discussed cannot be kept money good on a nominal basis unless real rates are negative? You would have to be an idiot to take negative real interest rates on your sovereign debt, particularly when your primary export, oil, has to rise in terms of those bonds just to keep production flat. So at some point, oil exporters get motivated to shift into a reserve asset that can rise in price and keep them, on par. And if you look since 1870, in 1870, an ounce of gold was 24 barrels an ounce. Today, it's 22 barrels an ounce, right? So gold holds its value in oil, period. In contrast, U.S. Treasuries in 1946, $1,000 face value U.S. Treasury bought you 100 barrels of oil, give or take, and now it buys you 16. Sovereign debt collapses against oil, give or take. That's just since 1970 or 75. So the exporters are motivated to store surplus in something that preserves the real value, the oil real value of their wealth, of their surpluses. Same time, your energy short oil importers, your energy short creditor oil importers, right? So your Chinas, your Japans, your Europes, your Indias, they're looking at this going, we can see what happens when oil goes up. We saw it this year. What happens? Japan goes into not just from a current account surplus, they go into a current account deficit. What happens to the yen? It crashes. Europe goes from being current account surplus into current account deficit because oil goes up. What happens to the euro? Crashes. You get into this dynamic where they have the same motivation from the other side and oh, by the way, this isn't just Europe and Japan and India and China. This is Ghana, and this is Turkey, and this is all these emerging markets around the world. They are running current account surpluses. When energy pushes them into a deficit, into a current account deficit, they go into their currencies collapse. They have to sell dollars to buy energy, or they have to cut energy purchases. They go into a currency crisis. So how do they prevent this from happening? It's the same dynamic. They need to buy energy in their own currency, except they don't want to issue debt. They don't want to run the same model as the U.S., which is buy energy in our currency and then just take our bonds, because that means you have to offshore all of your manufacturing, and none of them want to do that. So what they have to settle in something, though. Some of them will settle in goods, but there will still be net left over. What do you settle in? Well, nobody trusts anybody else, so everybody wants gold. I think gold for oil is an inevitability. I think it's already underway on some level. Now, where it gets really interesting is like where Ghana just came out and said, we're going to barter oil for gold 2 weeks ago. If they can barter gold for oil, they can go to Russia and say, listen, we'll do the deal with you, except we're not going to, let's not do it at the COMEX, gold to oil ratio, right? Gold on COMEX, oil on NYMEX. The COMEX NYMEX gold to oil ratio is wherever it is today, 22, say it's 22 barrels per ounce. Ghana can go to Russia and go, listen, we'll give you 25 barrels per ounce, right? Let us buy at 25 barrels an ounce. Let's value the gold up.
Greetings and salutations, Janusian Nation. I hope this finds you well. Welcome to our video on gold. We think that a tectonic shift in the monetary system is coming. The fundamental issue with the current system is that the USA can no longer keep good on promises to maintain the value of the US dollar and US treasuries, something that we're going to get into in greater depth in later on in the video. And as a result, the world's moving towards a new monetary asset that can act both as a medium of exchange and as a store of value. Oil for gold, as Ghana announced in 2022, is a significant landmark of that shift, especially given that oil is the benchmark commodity for the economy. So very quietly, especially with case to the countries that are in the BRICS, Brazil, Russia, India, China, and South Africa, and more broadly the BRICS Plus, these central banks have started to acquire gold. Well, we're not a bunch of gold bugs or Ayn Rand libertarians. We don't promote an agenda to bring society back to radical individualism. And we aren't of the view either that the world is reverting to the pre-1930s gold standard. But yes, for matters of disclosure, we do own gold and Bitcoin in our portfolio. But this is not an ideological proposition for us. So our agenda for today is to, first of all, talk about the theme that the global monetary system is in the process of collapsing. We're going to go over the historical gold standard and the current monetary system. We're going to look at recurring themes of the global monetary system. We're going to discuss how the West broke the promise that underpins the global monetary system. And we're going to suggest that gold is the path of least resistance for a new monetary restructuring. For those of you who have no context, we have a short clip from our previous video on Saudi Arabia and the petrodollar. So there was a gold standard in place before the 1930s. So the gold standard can be described as a fixed exchange rate. Modern day comparables would be the Hong Kong dollar to US dollar and the Saudi Arabian currency to the US dollar. The idea was that by pegging yourself to hard currency, you afford monetary stability. Central banks maintained the peg by having gold in their reserves, 30% in the case of the US Fed and Bank of England, and guaranteeing that it would be redeemable in gold coin upon request to other central banks. Since UK was at the center of global trade and finance, most gold bars were stored in the UK at the height of the gold standard before World War I, and the UK pound was used as equivalent to gold as the stability was maintained. So why did the gold standard collapse? Well, pre-1914, the gold standard collapsed with World War I. The UK and European nations printed too much money during World War I to finance the war effort. The UK briefly attempted to repeg the currency to pre-war levels in 1920s under the Chancellor of the Exchequer, and that effort spectacularly failed, and one reason that caused the Great Depression. Keynes called the gold standard a barbarous relic after Churchill's effort spectacularly failed. Towards the end of the war, the UK and US realized they had to restore the international monetary system. Global financiers and government officials got together in Bretton Woods in 1944 before the end of the war. There were two proposals. The first proposal was the Harry Dexter White proposal, a US dollar reserve currency plan. Harry Dexter White was a senior official representing the US Treasury. His plan was repegging the US dollar at $35 an ounce. Rest of the world pegs to the US dollar. For example, the British pound would equal 2.8 US dollars, or 3.3 Deutschmarks would equal a US dollar, etc. The world uses US dollar as a savings and trading vehicle. US dollar is always redeemable in gold for sovereigns. This created US dollar as a reserve currency. The second proposal came from John Maynard Keynes. His proposal was a neutral international money plan. Central international monetary institutions, or an institution like the International Monetary Fund, creates money that's called Bancor. Bancor is a unit of account used as a settlement mechanism between nation states. Wouldn't be available for use by the public. Nations can use gold to buy Bancor, but not the other way around. U.S. proposal won the day. U.S. had over 50% of monetary gold by the time World War II was over. Since the USA was the only one with substantial gold left, it made sense for the USA to issue gold-backed currency. Bretton Woods system eventually collapsed in 1971 after Nixon shut down the gold window. The U.S. ended up printing too much U.S. dollars, and convertibility of U.S. dollar to gold came into question, principally for two reasons. So first of all, they had a massive deficit in the 1960s due to Vietnam and their social programs, which were loosely dubbed the Great Society programs. And second of all, as the global economy grew and recovered from World War II, the demand for U.S. dollars went up as production went up. So the rigidity of the global supply prevented expansion of U.S. Dollar supply, and as a result, the system was headed for an inevitable collapse. So the structure underpinning our current monetary order, as we discussed, is fundamentally is this petrodollar relationship, the relationship between the fact that the oil is the number one consumed commodity in the world, and the U.S. dollar is used in the purchase of oil and other commodities as a reserve currency. And as a result, the U.S. runs a perpetual current account deficit, and they finance global trade, and they then create demand for the U.S. dollar because commodities are priced in U.S. dollars. So the USA, of course, has offered security guarantees and provided the financial infrastructure to underpin this global currency. So one of the things we can think about, again, I think Mark Twain said that history doesn't repeat, but it rhymes. And so what you see is sort of repeated cycles in terms of the way things play out in history that have similarities with past events or time periods that we've gone through. So with respect to the lifespan of a global monetary system, we can identify the following cycle. So there's a new power structure that creates a need for new money. So an example of this would be Britain's colonization of the world, or the USA emerging as the dominant economy in the world post-World War II. A new monetary system gets created, global trade and the global economy expands under the stability of the new power structure. Over the course of time, there's a new rising power structure that challenges the old power. In the case of the UK, it was Germany, and now with the USA in the current system, we could see that China and Russia collectively are threatening or challenging the old power structure. War breaks out, inflation ensues, check mark, and then subsequently we see a collapse of the monetary system. So we saw this happen, of course, in 1918 and World War II, and now question mark, will we see something similar as a result of in the wake of the Russo-Ukraine War? And recall that from our last video that Zoltan Pozsar talked about how we're effectively fighting wars on many fronts. Hot wars in cold places, as he put it. So there's an inflationary crisis, and the new global order enforces the need for a new monetary order. That's the next thing that happens after war breaks out. So what we've seen now more recently is that the global south has expanded its productive capacity over the last 30 years. And China's industrial production capacity already exceeded that of the United States in 2010. So the global south controls energy, clean tech, and manufacturing, and also a lot of food if you're looking at Russia-Ukraine nexus. So if we look at this hot war in cold places going on in the proxy war between the West and Russia, we can see that Russian President Vladimir Putin mentioned that he wants a multipolar world. Putin has said that he's not willing to sell oil in a currency that is inflating by 8% per year. So the logic is you've got oil as Russia, which is a depleting asset, and if you're storing your wealth in something that is depreciating, where the real rate of return is depreciating, then as a oil producer, you're necessarily going to end up a loser because you're giving away essentially your productive inheritance.
Россия считает неизбежным процесс формирования новых международных финансовых платформ, в том числе для целей международных расчетов. Такие платформы должны находиться вне национальных юрисдикций, быть безопасными, деполитизированными, автоматизированными и не зависеть от какого-либо единого центра управления. Возможно это сделать или нет? Конечно, да. Потребует немало усилий. Объединение усилий многих стран. Но сделать это можно. И это исключит возможность злоупотребления в сфере новой глобальной финансовой инфраструктуры. Позволит эффективно, выгодно и безопасно обходиться при международных сделках без доллара и других так называемых резервных валют. Тем более, что, используя доллар как оружие, Соединенные Штаты, да и Запад в целом, дискредитировал Институт международных финансовых резервов.
So now the West has broken their promise around the global monetary order. So first of all, one of the things where we made a promise was that the rate of return of U.S. Treasuries would exceed the rate of inflation. Another promise was that stable energy supply would be flowing from the Middle East and Russia. A third promise is that U.S. military dominance would be able to secure global trade. And then a fourth one is that the U.S. would enforce property rights for foreign investors. Now, the West has broken the promise, at least from the perspective of the global South. First, let's look at the question of the rate of return of the U.S. Treasuries exceeding the rate of inflation. So if we go back to the Great Recession and the financial crisis of 2007 through 2009, that financial crisis and quantitative easing, which was used by Bernanke, where essentially killed the real return on U.S. Treasuries. U.S. deficit spending and welfare guarantees have killed the U.S. Treasury's function as a store of value. So the U.S. has overpromised its ability to deliver on Social Security benefits and Medicare. It's spending on military spending, and this is combined with its social spending during COVID, of course, which we've discussed, have all put inflationary pressures on the U.S. dollar. So the second promise was a stable energy supply flowing from the Middle East and Russia. So we are now essentially at war, of course, with Russia, and we consume 45 million barrels of oil a day, but produce only 30. And so the West has not invested in hydrocarbon infrastructure and has been preparing for war for eight years with Russia, and we didn't invest in a hydrocarbon infrastructure in the meantime. The third promise was a U.S. military dominance to secure global trade. Well, right now we see that the U.S. military is thinly stretched throughout the world. The U.S. hasn't won a high-intensity conflict since World War II. Iraq in 1991 doesn't count. U.S. military is feeling the impact of deindustrialization. For example, a lot of its military parts are actually built in China, for example, with the F-35 fighter plane. And the fourth place where, from the Global South's perspective, the U.S. has broken its promise is that with respect to enforcing property rights. So the U.S. Closed the U.S. dollar window on Iran. There's a payment system called SWIFT, and Iran and Russia have been taken out of that payment system. The West is confiscating Russian assets, and the U.S. Treasury openly talks about weaponizing the dollar against rogue states. So what follows is a brief segment from a U.S. security and risk analyst named Matt Pines, and he suggests that the Russo-Ukraine War was a turning point for the end of the global order as we know it.
Money, at least in our current context, and really for most of human history, is an expression of sovereign's sphere of influence, right? Where you decide who is going to be allowed to access your institutions, mainly your banks, under what terms, what rules of law. And you can, limit access to those institutions. You can provide an open capital account. You can have a closed capital account. So money is always an expression of kind of the sovereign's sphere of influence. And the United States has sort of set a global environment post-war where we could create essentially a monetary commons. And the premise of a monetary commons is that it has really no gates, right? Like an open park. Anyone can walk in and anyone can go out. The dollar was a monetary commons. Anyone could use it. That was why it became the global reserve currency, is because it was so easy to use, and it sort of also correlated with U.S. power. Like, we were the global security guarantee to global trade post-World War II. And so people, just endogenously started trading in dollars and denominating their offshore loans in dollars. That was the genesis of the Eurodollar system. And what we've seen really in the past 20 years, and really it really hit a new phase after the global financial crisis, was the global monetary commons basically broke. And then we've increasingly sort of gated it with the sanctions on Iran. And then in the last year or two, we're starting to see like more and more conditional access policies be placed on this, what was normally like an open global monetary commons. And I think that is changing kind of the risk premium that all global actors, in particular the more strategically important, like sovereign wealth funds, FX reserve managers, have to now place a new like political and geopolitical risk premium on their what was formerly thought to be like a risk-free access to global monetary commons.
Would you say then sanctioning the Russia's U.S. debt, U.S. bank holders, would you say that was a miscalculation?
I think history will see that as a major pivot and maybe it was inevitable, right? Like history is contingent, so it can play out in a lot of ways. But I think it was not, I don't think they thought through all the second and third order consequences. I think that sanction was done because we wanted to do something extremely significant, but below like the threshold of like casus belli with Russia. Like, we wanted to punish them as severely as we could, but we knew we weren't going to do a no-fly zone. We weren't going to like put SEAL teams behind enemy lines and blow stuff up. Like, we weren't going to do anything like kinetic against Russia. So Biden was like, give me like the most substantial non-kinetic punishment that we can lay on Russia. And I think the guys in the National Security Council, talked to some folks at the Fed or folks at the U.S. Treasury Department, were like, what's like the biggest hammer we can swing that isn't going to cause a war? And they're like, well, we could sanction all their dollars. And okay, we'll do that. And I think it was decided over a weekend, basically. I don't think anyone modeled out, what folks in, say, the PIF or the SAMA, which is the sovereign wealth funds of Saudi Arabia, would think about that, or think about what the Indians would think about that. Think about what some of these other kind of powers in the world that are critical to the stability of the dollar system, that are potentially going to be gaining more relative power. And now they see that as a signal that if, okay, maybe the Ukrainian situation is morally justified to bring the sanction on them. Well, what's to stop a future U.S. political administration to now wield this as a tool of geoeconomic coercion against me for something that I think is in my legitimate national interest? And now I have this vulnerability that I didn't really think was all that severe, and now I have to increase the risk premium I attach to it. I think that was not well modeled out. I think that's something that's hard to model, but it's also that's the those are the things you typically, when you think about strategic mistakes, those are the things that you look back on. You think, oh, well, this precipitated a whole set of decisions and hedging behavior that maybe individually doesn't change everything, but in aggregate can cause a strategic effect.
Now, what we see is that the BRICS or BRICS Plus are thinking about creating a competing currency that will supplant the U.S. dollar reserve system. And we're going to show a clip from a gentleman named Simon Hunt, who's a Dubai-based commodity expert that discusses the BRICS or BRICS Plus commodity basket currency that they're thinking of creating.
What we've got is we have a war in Ukraine, but it's not a war Ukraine versus Russia. It's a war NATO versus Russia and China, which is being played out in Ukraine. That war is very likely to spread to other countries. And it's really all about, from the Western Alliance's point of view, that they're running scared, you might say, that China and Russia, through the Eurasian Economic Union, will create a new currency and trading platform that does not need the dollar. Mm. And it's a currency which will be based on the weighted average of member currencies, plus the commodities that they produce, but those commodities linked to gold, not to dollars.
And this Eurasian commodity-backed currency, is this theoretical, or is there any meat in the bones to this?
No, it's got meat to it. Where are we now? We're in May. In March, the first draft was shown to the Committee of the Eurasian Economic Union. They then said, bring us back the final draft by the end of the month, end of March. And I've just read an interview with a very, very senior person in the Kremlin about this new currency and signaling it's any day now. It may be tomorrow, it may not be in 6 months, may not be for 2 years, but it's ready to be unveiled.
So BRICS are moving towards a new currency and monetary system, and things are currently in the construction or elementary stage. Simon Hunt believes that there could be a competing currency system in place by as early as 2025. Right now, there's discussions of settlement of energy trade in local currencies. So China, Russia, China, Saudi Arabia, Russia, India, and discussions are happening to create a currency based on a commodity basket. So it wouldn't just be oil, copper, the metals that are used in the transition towards EV or clean tech, et cetera, will be included. So how do you construct a monetary system? Well, you need the following systemic design to create a new monetary order. First thing you need is payment, rail, and financial infrastructure. So you need ways to facilitate payments and financial trades. So currently, the U.S. dollar system is dominated by things like the SWIFT payment system, the Chicago Mercantile Exchange, the New York Stock Exchange, various exchange systems to facilitate payments, where you have futures contracts, and of course, a banking system that allows the over-the-counter market. Number two, you need a reserve asset. So, of course, right now the reserve asset is U.S. Treasuries. So you need ways to store your wealth and surplus in assets. And third, you need energy and security guarantees. And so, of course, the dominance of the U.S. military and implicit guarantee on petroleum supplies have been enabling global trade up to now. So how are the BRICS planning on creating a new system? So the payment rail and financial infrastructure, they will begin with bilateral settlement between nations, and then you could also use the Shanghai Commodity Exchange as a vehicle for transactions, as well as they've looked into even digital currencies as a possibility. Second of all, the creation of a reserve asset. So you need some sort of commodity-based currency, probably gold-based currency, gold stored in neutral locations. Down the road, again, could be digital-based security as well. And then you need an energy and security guarantee. So Russia and China are selling weapons to Middle Eastern countries. So Russia sold MiG-29 jets to Iran, for example. Saudi and Russia are selling energy to BRICS members and are buying, allowing them to buy that energy in renminbi or BRICS currency. So where does gold come into play in all this? So gold is an apolitical reserve asset with a fixed known supply. The supply tends to grow by 1 to 1.5% a year. The BRICS plus monetary institutions will print out IOUs based on gold holdings. BRICS currency floats against national currencies. And then countries running trade deficits will pay the trade surplus side with the BRICS currency. This is essentially a Bancor idea, so a neutral asset used to settle an international trade balance. So if we look back to the example this video opened on, which was Luke Groman's example of Ghana, Russia offers to sell oil in various currency. Russia charges different prices for different currencies. But if Ghana wants to pay in gold, Russia would offer, say, a 20% discount versus what they would get in US dollar. Ghana then buys the gold from China or gold-denominated BRICS currency and pays Russia. So we need a caveat here. We're not expecting any kind of return to a gold standard. So there are people and certain YouTube pundits that talk about China backing the renminbi with the RMB with gold. That's not going to happen. So the reason is that if you peg your currency to gold, it creates too much monetary rigidity domestically. So gold will be used as a settlement mechanism over trade imbalances between nations. So nobody is going to back their national currency with gold as a major feature of this new currency system. China is getting ready to set up the Shanghai exchange with their gold exchange to facilitate international trade flows. That's what's going to happen. Gold's going to be allowed to be a settlement mechanism for trade imbalances. So what is the USA's counter move if they want to maintain or extend the US dollar as the primary monetary asset? Well, one option that they would have is to embrace another apolitical reserve asset other than US Treasuries. Another option would be to go to Canada and allies for more oil production. A third option is waging proxy wars in China and Russia-backed states. Third option is invading Africa for sources of clean energy. A fourth option is extending Russia and encircling China. Of course, some or all of these options are underway as we're talking about it. And this extending Russia and encircling China will be the subject of our next video. And we'll explore USA's counter moves in subsequent videos. Well, that does it for this video, Genusian Nation. I hope you found the information and content useful for your perspectives. And I hope, again, that this finds you well and that we'll see you soon. Be well. Cheers.